Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you with us. Glad you could join us today. Let me see. Today we're talking about, well, hate to say this, but it looks like it's over for the Mag 7 stocks. What? That can't be. We'll talk about that. Is using part of your 401k for a down payment on your home a good idea? This is something being tossed around by the president currently, so we'll discuss that. And here's something maybe concerned about. AI will create jobs that have not even been imagined yet. So there's some things out there that will be coming out that you haven't even thought of yet, and some we don't even have yet.
yeah, there's going to be some changes to that. Excited to get into that topic. And also, as always, we're going to look at some companies, break down the fundamentals, give you idea if we think it's a buy, sell, or hold based off the valuations, the balance sheet, the numbers that we see here. Companies we're looking at includes Expand Energy, used to be Chesapeake. A lot going on at Nat Gas this week, so I thought we'd look there. Also, we're going to look at Citigroup, Kraft Heinz, and GameStop. All those had some interesting news this past week, and Citigroup reported earnings last week.
And a good mix of company, energy, financial, food, all kinds of crazy things. A meme stock.
Yeah.
Well, let's dive into, looks like it's over for the Mag 7 stocks. Now, this is something I found very interesting. The name Magnificent 7, I actually thought Jim Cramer, somebody named it. That is not the case. It came out in 2023 by a strategist from Bank of America named Michael Harnett. The idea is the name came from a classic Western movie featuring 7 heroic gunfighters and their push to save a small town. That's where that name came from. I always wondered that. But just like other hot themes, like remember the Nifty 50 back in the 60s, BRIC, which is BRIC, we had to be invested in the emerging markets of Brazil, Russia, India, and China. Well, it looks like the Mag 7 days or glory days are getting over, just like it happened with the Nifty 50, the BRIC, and there's a couple other ones as well.
.com, we always talk about that one, but I mean, I don't want to say everybody. Most people know .com. A lot of people don't maybe remember Nifty 50 because, I mean, shoot, that was in the 70s. So, you know, even people that were investing back then and alive today, I mean, you'd have to be pushing 90 to actually had a substantial amount of investments back at that time. But I was going to say, you know, you talk about where Mag 7 came from. We've talked about this before, but do you remember how many of the Magnificent 7 survived in the movie?
No, I didn't know that.
Just 3 of the 7 gunfighters survived. So will we see a similar case? Now, I think it's a little bit different because I don't think any of the Mag 7 are going bankrupt. But, you know, the performance, I think, is the big question there. Will there be 3 survivors that maybe win the AI game?
I think there'll be survivors, but I think they could be very heavily wounded.
Well, we're kind of looking here at the numbers, and in 2025, only 2 companies, Alphabet and NVIDIA, outperformed the S&P 500. I think a lot of people were surprised, obviously, at the way things transpired for Alphabet, but they were the big winner, actually, of the Mag 7. I bet you at the beginning of the year, most people would not have picked Alphabet to be the top dog there, but they were. Microsoft, Meta, Apple, Amazon, and Tesla were no longer called stock market stars, and I believe this year will be another year of underperformance for most of these players. The Mag 7, will they still account for about 36% of the S&P 500's market cap, which is why I do believe the S&P 500 will not have a great year in 2026. I don't know if we'll have a down year for the S&P 500, but I think the returns are going to be subdued, and definitely don't expect the returns that we've seen the last 3 years, I think, to repeat itself of close to 20% gains.
And the thing is, accounting for 36% of the S&P 500, if they don't do well, that's a third, over a third of the S&P 500. It's very hard to do well, especially the size of the market cap of those companies. That's why it's such a big part of the S&P 500.
Well, I mean, we'll get some good insight next week. I believe it's Microsoft, Meta, I think Tesla's in there as well, and Apple. I believe those 4 companies report Wednesday or Thursday of next week.
You know, I forgot what show I was watching, but they said, do you know anybody that uses Copilot from Microsoft? They go, no, we don't.
Well, I think everybody has it on their computer, but do they
we
actually
have it?
utilize it? Yeah, I mean, we could use it. Yeah,
Oh.
I think the button pops up there
But
from time to time.
we don't pay for it. I guess maybe that's
No,
the
I
thing.
think they lump it in. And I do wonder how much of the data is massaged. Like, yeah, there's 10 million users of Copilot, but it's just people that have it on the computer, maybe not actively using it. I don't know the exact details because we don't own Microsoft, so I don't know the exact numbers behind their AI success, or I'm going to say lack of success, because I know some people have really pointed out that, I'll use Mark Benioff as the prime example at Salesforce. He's called it Clippy, I think, 2.0. The little, the little clip that came from Microsoft. I guess we'll see. I mean, if we get more data from Microsoft next week on how Copilot and their AI strategy is working out.
And they are kind of saying as well that they do expect that these companies, this is a year, because they've been developing. This is the year you actually have to perform.
Yeah.
So, yeah. But it will be hard for investors to give up these companies because as they look in the rearview mirror, they feel, wow, this company is great. I made a lot of money off it. It's worth what it's trading at because, again, they made very good returns in the past. And that's no way to do investing. However, just like the Nifty 50 and other hot investment themes throughout history, everything comes back to the mean, comes back to the average. Nothing stays on the top forever. It eventually comes back down to the normal area.
Yeah, and the big problem I see is a lot of times when people make a lot of money investing, well, then the next question becomes, what will the next hot investment idea be? And frankly, no one knows for sure, but I'm confident someone on Wall Street will come up with some exciting name for investors to chase, and then they'll tell them not to worry about the fundamentals of the business. And we know short term, I'm going to say fundamentals don't matter. I mean, they don't. Your guess is as good as mine as what's going to happen in the stock market tomorrow, next week, next month. But long term, as Benjamin Graham said, it's a weighing machine. The fundamentals do weigh out in the long term. And I don't want to say the Mag 7 are bad companies, but I pick on Apple a lot. Trades at 30 times earnings with limited growth. Why the heck does that happen? It just doesn't make much sense. And I think, it's funny, again, picking on Apple more detail. At first, it was like, well, they don't have an AI strategy, so they were punished. Well, now they're going to have a good AI strategy because they don't really have an AI strategy. You're like, what the heck does that mean? Like, it just is crazy the things that people will justify with some of these Mag 7 companies. And as you said, I think 2026 is maybe finally going to be that show me year. Right. Not the hype anymore. What's the saying? The proof is in the pudding.
Proof is in the pudding.
I want to see that
show
pudding.
Me the money.
Yeah.
Show me the money.
I want to see the pudding. Yeah.
And also, I mean, Apple last year, I mean, again, picking on them a little bit, but congratulations, we said before, for recovering from the down period that they had. But still, your return last year on Apple, I think, was only like 7%. It wasn't a great gain. It didn't even come close to the S&P 500.
Yeah, I mean, the 1 year return, obviously, now that's January 23rd of last year through January 23rd of this year. It's 11%.
1%.
And that includes their big dividend of 0.5%.
Yeah. Still not worth trading 30 times earnings.
And I know Microsoft, I think, was even worse. I think their 1 year return is 4%. And that's after a 3% gain on Friday. So, I mean, realistically, it was up about 1%.
Yeah, they are struggling. That's why we're kind of talking about that. But let's talk about this, is using part of your 401k for a down payment on your home. Is that a good idea? Well, the president is trying very hard to stimulate the housing market and allow younger people to buy their first home. One idea that's been tossed around is allowing people to use their 401k for a down payment. Now, people can currently borrow from their 401k, and I often hear, I'm going to say this, uninformed people say it's a great thing because, wow, I get to pay myself back. I can't do any better than that. That's the best thing I can do.
Yeah, and I mean, just kind of briefly, and I hope I can kind of get this across just on air, but it's really not that great of an idea because those quote-unquote interest payments that you're making to yourself, well, they don't account for the negative impact of the opportunity cost for what those funds could have grown at. So again, maybe you're paying yourself back, 7%, let's say, but if it could have grown at 10%, well, now obviously you lost out on some big gains on that lump sum you took out. And the other thing I point out for people, you don't get a tax deduction when paying the loan. So I'm just going to say you pull out $50,000, right? It's a tax-free distribution from your 401k. But now when you're paying yourself back that 7-8% interest rate, you don't get a tax deduction on those interest payments like you got when you put in the money on that pre-tax basis. But then the big problem is you pay taxes on the distributions at a later date when you are actually withdrawing those funds. So there is a negative tax impact when you also do these 401k loans.
Yeah. And these are things why people
Don't you love
understand.
that, right? You put something in, no tax deduction, and then you get to pay taxes on the way out too. I mean, that to me even drives up that interest differential between borrowing the money versus your 401k loan. That makes that spread even larger.
And just a difference of, say the investment would earn 10%, you say 7% for the interest. Well, at 10%, your money will double about every 7 years. At 7%, it's about every 10 years. And that really starts making a big difference when you start talking 20, 30, 40 years. All of a sudden, I'm just throwing out numbers here, you could have $100,000 less in your portfolio. And what that means for the income side, you may get a $700 a month less on your retirement because you borrowed against your 401k and paid you back that 7% interest. What a great thing. No, it's a terrible thing.
I really want to harp on this tax thing too, because when you actually look at the numbers, I mean, if you're paying, again, I'm going to say 8% interest, I looked it up. That's about where I've kind of seen interest rates trending lately. When you're doing that, I mean, most people, they're going to be, maybe 22% tax bracket federally, 9.3% tax bracket in the state. I mean, that's 31.3% tax on distributions that you now essentially have increased that interest rate that you borrowed money at because you again, don't get any tax benefit and then you pay tax on the way out. I mean, that is a terrible deal when you break down those numbers. And again, looking at saying, well, I can borrow money maybe at, let's say, 6%, even 7% from the bank, that to me is far more valuable than borrowing that money from your 401k.
Yeah, it's just not a good idea. Now, outside of 401k loans, now the administration is looking to help first-time buyers. What are they trying to do here? Well, Kevin Hassett, who is director of the National Economic Council, threw out one more possibility, that a homeowner could put 10% of their equity of their home into a 401k. That may make your 401k balance look, in our opinion, artificially high, because as the home grows in value, so does that 10%, but you can't tap that 10%. It's just a crazy thing. And I know they're trying so hard to help out the people buy homes in the housing market. Sometimes there's nothing to do because I think some of these things they're talking about sounds great now. I think 10, 20 years down the road, it can be a disaster.
Yeah, and I think the big thing you point out is that you can't tap it. So, the whole point of the 401k is, in many cases, to provide retirement income. So you have, again, 10% of your home equity is in the 401k. Let's just make it easy on me. Let's say your 401k is worth $1 million, but your home equity is maybe worth $200,000 of that. You look at your 401k, say, hey, I have $1 million in my 401k. Well, not really. You have $800,000 in liquid 401k monies. The rest is in your house. And the big thing that I look at is TPAs, third-party administrators, they're probably just like, man, what are you guys doing to us? Yeah. How do you account for that? How do you track that? Do you have to get a home valuation every single year to then look at how that is being impacted in your 401k? I mean, there's so many questions. I know Charlie Scharf, the CEO of Wells Fargo, he said, maybe there's some positives to that idea, but again, the details are really what's going to matter here. And again, these are all just high-level concepts without much of a plan in place. And I think really the details would have to be there because this, to me, is so complicated, confusing, and I think it could, as you said, hurt people in the long term.
Yeah, and I think it's a short-term solution that is going to hurt long-term. And you got to really dig through the numbers. And again, I know they're trying so hard to help people out. And again, as I said, sometimes you just can't. You can't do it. I mean, the way to really do it is to build a lot more homes, increase the supply. But builders don't want to do that because, well, then they're going to get hurt. Sometimes you got to work through things, and it can take, economic cycles 7 to 10 years. We may have to go through that to work through this.
Well, my concern is they do too much to help goose the demand side of the equation. All that does is lift prices potentially, and then you're in the same affordability crisis for new buyers, and it's actually even maybe worse because now home prices are even further away. So, I mean, as you said, the big thing they have to fix is supply. Because if they keep trying to goose demand, that's just going to lift prices and not solve the affordability issue.
And we do have next week on our newsletter, and maybe we'll talk about on the radio show as well, about the people that own homes versus those that don't, kind of the competition between the two. They want different things, and you can't satisfy everybody on this situation. So we'll maybe talk about that more next week here on the show. If not, make sure you get our newsletter. But let's talk about AI will create jobs that, have not even been imagined yet. Some jobs we looked at, there are jobs that are starting to be seen and developed as AI becomes more involved in business. One example is someone has to make sure that the systems are kept up to date and functioning properly. There's also going to be people that have to understand the technology thoroughly and then translate the output to managers, judges, regulators, anyone else who's using that information has to understand, like, well, what does this mean? And there's going to be people that will actually help these other people understand what's coming out.
Yeah, and experts, as you said, will have to look at things like self-driving as an example, self-driving vehicles and how that technology works. Say there's a car accident with 2 self-driving cars. Well, then who determines who's at fault? There will need to be experts that understand the self-driving technology and then try to explain the situation. The AI system will have to be checked from time to time to verify that AI system did not produce results that were unfairly skewed in one direction or the other. So again, there's just more and more data that's coming about, and people have to understand the data.
And I love that one, that point you brought up there, Chase, because again, you're going to have 2 cars that are self-driving. The other thing too that comes up, we've talked about this. Who do you insure? Are you insuring the car? Are you insuring the driver? Well, the driver's not driving, so you insure the car. Then you have to know the system. How good is the system? I mean, there's going to be jobs, and again, we just pointed out a few here, that are going to be created because they need to get answers to these questions. So, and once that is discovered, another expert, would have to know how to fix and eliminate those problems using new data that helps eliminate the bias. Training is another area of opportunity as people change, their jobs change. They will need training in the new technology. The expert trainer would also use the technology to figure out what teaching style works best with the individual. I thought that was pretty neat there as well.
Yeah, I mean, the thing that you look at here with AI is, again, it's kind of changing the game in some of our society. And the thing you look at is the future is always scary because of the unknown, but innovation, it continues onward, and it really continues to create new opportunities and problems that need to be solved. I mean, while we're kind of talking here, I have kind of gotten ads or inbound calls from people that are saying, oh, let us help with your AI strategy. So, that's another thing is, well, how to implement AI in your business. Now, I haven't really taken up any of those people on that opportunity, but, that is, again, another job that has been created that wasn't around a few years ago. Another thing, too, is, as you said, AI is not perfect. So making sure that AI is accurate, right? That's kind of a job in and of itself. You might need almost an AI compliance department to make sure you're getting good stuff. And, I was on KOSI this past week, and I was kind of talking about social media. And I'm going to say it's a little bit different because social media didn't really take away jobs necessarily or have the threat of taking away jobs. But I brought this point up before, and it just kind of makes me laugh. But one of the jobs that came about from social media that I never would imagine, I bet you people 15, 20 years ago would never would imagine, is people when they get married now, they'll hire a social media person to follow them around and post their Instagram lives and, do the content for their social media during their wedding. I mean, that is one thing, again, with technology is it's an extreme example, but I think I can even conceptualize maybe 3 to 5 years from now what jobs could be created from AI.
Yeah, and this did kind of happen, not to the same degree. Maybe it did because your memory doesn't always collect on the real negatives. But when the computers came out and technology came out big in 2000, it used to be when I went to school, you had to do spreadsheets and handwrite those. Well, computer does it in 30 seconds, maybe a minute or so. That eliminated a lot of jobs because you didn't need 10 accountants filling in the spreadsheets. I remember those papers that go across, 10 different columns, and you had to fill them in and write them in. Very small handwriting. That eliminated jobs. So it did do a lot, but it created new jobs. And that's the thing I look at. It's always scary. Even the Industrial Revolution. Oh my gosh, all these farmers are going to lose their job. What are they going to do? We don't need farmers. It creates. So it does have a way of doing it. You have to be prepared to move with the future, though. You can't say, well, I'm going to stay in this job. And what it is happening a lot, and I think we have this coming up next week as well, about maybe you shouldn't go to college because those are the jobs that are being replaced. About 30% of college graduates can't get a job now because they don't need them.
Yeah.
So
Well, it was actually in the newsletter, the white collar to blue collar
That's what I was talking about,
transition. And
was that this week or was that last week?
that was this week.
This week, okay.
Yeah, and the big thing I tell people here is I think customer service and leaning into human connection, it sounds kind of funny with the advancements in technology, but leaning into that human connection, I think, is really what separates people. And I'll tell you, I've had to contact a few different larger companies over the past few weeks. I had a health insurance company I had to contact. I had the hospital I had to contact. I had to contact a car leasing company and then a car inspection company. And I bring this up because it drives me absolutely crazy now when you call these big companies. You know how you used to press 0 and get an operator?
Right.
They removed that option. You have
shoot.
to go through this whole thing, and I think they're using AI to train the system to try and point you in the right direction. And it's like, oh my God, I'm on the phone for 15 minutes without even talking to a representative because they're trying to save time by not putting a representative and paying them there. But it is really just putting a wedge, I think, between the consumer and the business. And I bring this up because if you're a small business and you hire people that are good at customer service, I think that's where people can really prove their worth and not have as much risk over their job.
Yeah, and I think you're right. I think they'll be like, wow, I get to talk to a person. I want to deal with that company. So,
I feel that way completely now where it's like, oh my gosh, like I don't want the phone tree cycle to keep continuing. And I mean, just having that person is such an asset.
all this information does come from our newsletter. It goes out every Friday at 4 o'clock. We have other pieces in there, like what are the big tech companies doing about the potential shortage of energy in the future, some important financial misconceptions. Can Saks Fifth Avenue come back after bankruptcy? No matter who wins the bid for Warner Brothers, well, the movie theaters, I think they're going to lose out. Too much refinancing of mortgages could push mortgage rates higher. And here it is, Chase, your white-collar job is gone. Should you switch over to a blue-collar job? And there's actually, that is happening where people are doing that because they get paid more doing a blue-collar job than the white-collar job.
Yeah, and I did want to add one more thing about my frustration because I'm on one about it. It's actually, I called my mortgage company. And it's so funny when you call them, they're like, press 1 to make a payment. Press 2 to check your balance. And it's like, I can do both of those things online. I didn't call in to do these simple tasks. You know, it's just, I think there is going to be at some point a distinguishing factor for companies that are good at customer service and aren't good at customer service.
Yeah, and that's kind of what I got from that. That's why I know we're going to move on. But
Yeah.
You've got to get training on how to deal with people to understand the product because we're going to want to deal with people. Yeah. We're not going to want to have to deal with a machine or a robot all the time. So, all right, well, let's move on. Let's see. What are we doing here first? Expand Energy, I think, is what we're doing first on the companies here. They're Expand Energy. Their symbol is EXE. They're in the oil and gas E&P industry. 4% short on the float side, 95% institutional owned. PE ratio, unfortunately, not a good start. 35.1 versus 14.7. Price of sales, 2.4 versus 2.1. Price to book value, 1.4 versus 1.5. And price of cash flow, 6.5 versus 4.8. Not a great thing. No PEG ratio here either, unfortunately. Not great on the valuation sides for Expand Energy. Now, over the last year, the earnings, there's no growth on the earnings probably because they're negative. This is kind of strange. This could be because I forget when they took over Chesapeake, but it shows sales are up 157%. So that could be because of that merger there, or that acquisition, I guess. They do pay a 2.9% dividend, use 100% of the earnings to pay that out. That is not good. Look at the balance sheet, a little bit weak. The current ratio is 0.8 versus 1.4, so they are suffering from some liquidity. And then we do see the debt to equity does look good, though, 0.3 versus 0.5. We have a net profit margin of only 8%. I say only because the industry is at 14.5. We do see that free cash flow is $1.4 billion, not too bad. About half the industry at $2.7 billion. Chase, what do you got?
Yeah, so just a couple things to kind of bring up. You brought up the Chesapeake situation. So Chesapeake and Southwestern Energy completed their merger on October 1st, 2024. So that would be looking at that time period. Also, too, I point this out as an interesting thing, but Chesapeake did actually file bankruptcy in 2020 as they were struggling, and then they reemerged in early 2021, kind of cleaned up that balance sheet because you gave a pretty good balance sheet in terms of the debt to equity. Again, 2020, they were really struggling with debt levels.
And I do remember I had a client that came over to us, and she had Chesapeake Energy, and she would not sell it. I go, The balance sheet does not look very good. They got a lot of debt. It's not looking good. No, and I think it went up to 100. Chesapeake did, I think, at one point, or very close to it. Obviously, went bankrupt. She lost everything.
Yeah, it's high debt companies are very dangerous. Now, we looked at Chesapeake, or I said Chesapeake, Expand. They changed the name after the merger with Southwestern, but the current price here is $109.49, and we wanted to look at this because natural gas prices this week were just crazy. They're up 72% over the last 5 days.
Because the storm's back east.
The storm's back east, and I was reading this. A big winter storm is expected to dump heavy snow, sleet, and freezing rain across the southern Rockies, Plains, and the southern U.S. by Friday, and then is forecast to shift toward the East Coast through the weekend. And I'm like, wow, gosh, sometimes I hate living here in San Diego because of all the nonsense I'm going to say. But then you look at this and you're like, I guess that's why we live here. It was like 70 this week.
Yeah, I know. Oh, but it's cloudy out now. I think it's only 68. So,
But anyway, so that should obviously flow through considering this is the largest natural gas producer here in the United States. But 52-week range for Expand Energy. Again, their ticker symbol EXE. It's $91.02 is the low. The high, $126.62. Going forward for the business, we go out to December 2026. I see estimated earnings per share of $8.73. Gives you a target sell price of $144.92. Means it trades around 12.5 times those future earnings. Also, too, we will be getting new numbers here shortly for the business. If we look out to December 2027, it is estimated to climb further to $10.06. That would give us a target sale of almost $167 a share. So actually right around 11 times future earnings. But the big problem is the spread between the analysts. The low for 2026 is $5.43 and the high $13.07. These energy companies are hard to predict because you're not just predicting the business, you're trying to predict a volatile commodity like natural gas.
and again, we did see, as you said, up 70% on natural gas because of storms coming in. I didn't think it would ever move that much. That's just kind of crazy. And
I did see there was short positions at 14 months highs.
Oh.
So that really, I think, made that spike even more drastic than normal.
Right. And I think it's a good area to look at. I'm glad we looked at this company because we are concerned about energy usage, short of it because of all the data centers. But I just don't think this is the right company, the right time to buy it. I'm very cautious, and I just don't want to take that risk.
You have to understand these natural gas companies. I mean, with a volatile commodity like natural gas, I mean, things could be going great, and all of a sudden prices depressed, they get in over their heads, and then you end up with a Chesapeake from 2020.
Yeah.
And then you have big problems.
All right. Well, there's the news, or the break, not the news, the break there. When we come back, we got our financial planner, Harrison Johnson, starting up. Then we've got the other companies, Citi, Kraft, and GameStop. So stay with us. You listen to Smart Investing Show with Brent and Chase. All righty. Welcome back to the Smart Investing Show. And this is the time that we talk about financial planning. For that, we turn to our financial planning expert, Harrison Johnson, CFP. Harrison, thanks for joining us today. How you doing?
I'm doing great.
I like this topic. Start Social Security early to invest. And I want you to explain that so people understand what we're talking about and why.
The reason why we brought this up, there's an article in the Wall Street Journal recently that kind of talks about this. So I wanted to give my input and reasoning behind that. But basically, this article in the Wall Street Journal is saying that, should you collect Social Security early so that you can invest that money, as opposed to waiting to defer Social Security to receive the higher income. So with Social Security, you can collect as early as 62. You can defer until 70. This article is saying that it's better to wait until 70. And the reasoning behind that is your age 70 benefit is about 77% higher per month than if you collect at 62. And by doing so, you're increasing your guaranteed income in retirement, where, collecting early to invest the money, which most people don't do that. If you collect early, what that means is you're just going to be withdrawing less from your investments. But by doing so, you're kind of by collecting Social Security early, you can preserve your own assets to a greater extent, and then those larger assets can then create income to offset the fact that your Social Security per month is less. So that's kind of the question: do we collect early or do we collect late? And again, the article is saying it's better to wait because it's a guaranteed source of income. It does, though, say, well, if you were to collect early and then, that means you could invest the money or withdraw less from your portfolio. If you earn a reasonable rate of return, you do come out ahead in the long run, which I agree with. That's true. But it also says, but what if stocks go down and you lose 3% after inflation per year? That's not likely to happen, especially when you look at in here, it says if you retire, you're probably going to live to about 85 or so. So, people in their early 60s have a life expectancy of around 85. So from 62 to 85, that's 23 years. So the chances that you lose money over a 23-year span is extremely, extremely rare, especially when you factor that this calculation isn't about a lump sum. So it's not like you're investing everything right before the stock market potentially goes down. It's a monthly cash flow thing. And so you almost get the benefit of the dollar cost averaging of what that investment is. So I put together some numbers because
got to back it up.
You got to back it up. So essentially depends on what your portfolio is doing. If your portfolio is growing a lot, then collecting Social Security earlier so that you have more money that can be invested in growing, that's a good thing. But I have a couple different rate of returns. So if you earn 0%, so you keep money in a checking account or under a mattress or something, you're better off collecting Social Security at 62 if you live to about 78 or earlier. So if that's where you live, then you're better off collecting at 62. But again, that's with a 0% rate of return. If you can earn a 5% rate of return on average, now you're better off until a life expectancy of 84. If you have an 8% rate of return, then it's about 94. And if you can have a 10% on average return, you can live until infinity, and you will always come out ahead by collecting at 62.
So the longer you live, the better.
Well, yes.
Okay. That's
depending on the
right,
return,
number-wise,
because
return.
Obviously, if you die very early, then you want to collect Social Security early because you can get something. You don't want to, wait until 70 and then die at 71, and you would have never received everything.
But with the compounding, you do better longer term.
With the compounding, you do better longer term, but ultimately you have to look at how you're going to be investing that money. Because again, when you go into retirement, you generally have Social Security on one side, that's an income source, and then you have your portfolio that you would draw from, and that's your other source. You're going to live, you're going to spend money, so it's a matter of how much are you getting from Social Security, how much are you getting from the investments. You start Social Security earlier, you withdraw less from your investments can grow more and create more income later. So what is that money doing? What rate of return is it growing at? If it's growing at 0%, then in many cases, collecting Social Security later would probably be better because your money's not working for you. But in the vast majority of cases, and what really should be happening is your money should always be working for you no matter what age you are. Right. So if you have a return on average of, let's say, around 8%, now, as long as you live between, up to age 94, you're better off collecting sooner. If you can make 10%, then you can live forever, and age 62 would be better.
Never run out. And the thing, too, that's important that you want to look at as well, like they've got to have the discipline to do it, to invest it. That's what worries me is somebody like they do it for a couple of years and like, oh, I want to buy a new car. I want to buy a boat, whatever. It's like, well, that's not going to help you. So you got to be disciplined to do this. And then also, too, I just look at it for people that it makes sense if it's invested properly.
That's really what it comes down to. If you can be a good steward of capital, and we all should be trying to do that. This is a financial show. Hopefully that's the point of it.
That's what we try to get across.
That's what we're trying to get across. If we can be good with money, then getting money sooner from Social Security, not waiting 8 years of collecting nothing, gets us that capital so that we can use it. And again, that doesn't usually mean that you're collecting a Social Security check and then you're investing it right away. Usually you're getting that Social Security, you're spending it, and then you're not withdrawing as much from your investments. And if you can do that, more money stays in your portfolio. You have a larger amount of cash flow throughout your retirement, generally speaking. And then the other thing that's nice is that money gets inherited by your spouse or your kids, where Social Security is temporary. It stops when you die.
Builds the family wealth.
Builds the family wealth. Everyone always wants to do that. I want to build generational wealth. I want to, which is great. Well, don't, in many cases, deplete your assets to try and increase a temporary monthly benefit that's only going to last, until you die.
And he didn't mention that in the article, did he?
No, and I think that's the big flaw that people make is like, well, I get the guaranteed return on Social Security. You brought up this point already, but I want to reemphasize it. It's not growing a lump sum of money. It's not like you have $1 million in your 401k growing at 7-8%. That's not comparable to the benefit that you get on the Social Security. It's a cash flow stream that's growing for you, not an asset, not a lump sum, not a 401k. And that's what really changes the numbers equation, which Harrison tried to lay out here.
Yeah. Every year you wait on Social Security, the monthly amount increases by about 8%. So people will look at that and say, well, that means I'm getting an 8% return guaranteed by deferring. No, you are not, because you're also going to be receiving that larger amount for 1 year less. Because again, when you die, it stops. So by deferring, yes, the monthly dollar amount is increasing, but you're collecting that over then a shorter period of time. For the same reason, if you have money in a checking account that's earning nothing and you withdraw it evenly over 10 years, that amount that you can withdraw is going to be different as if you had withdrawn it over an 8-year period. If you only have 8 years to pull the money out, the annual amount is going to be larger. It's the same type of thing. That's an exaggeration, but that's why deferring doesn't mean you're giving yourself an 8% return, because you're shortening the time span.
I just realized I'm not taking my Social Security. I said, what am I doing?
So in your case...
Oh, here we go. It's not good for Brent.
No. It doesn't. Your spouse is younger than you. So in your case, she is going to get that amount when you pass.
Okay.
And today you went to her mom's birthday?
94th birthday.
Okay, so yeah. So she's younger than you, and she has longevity, so that means your Social Security amount is not just for the rest of your life, it's also the rest of hers. She should collect it as soon as she can. She's not there yet, but when she turns 62, that's going to be the time to collect. But in your case, we're not looking at the rest of your life, it's the rest of really her life. So that could be, 50 years or something.
And you bring up a very good point. This is why you have to talk to a financial planner that knows what they're talking about, because it's not 100% always this way. You brought up, well, no, not for you because of your younger wife. There can be so many other things. That's why you can't just do something and say, I've heard this, well, Joe did it, so I did it. Like, you and Joe are different. So that's why a good fee-based financial planner is worth your weight in gold.
Right.
Although you're pretty heavy. Whoa. You're a big guy. I mean, you're what, 6'4"?
6'4", yeah. I've lost some weight lately. I only weigh right now like 210 pounds. I used to be like 235 when I was working out a lot.
Okay. All right. So, we'll move on from the weight comment. Well, good. Okay. Well, I think that was very helpful for people. I mean, again, and the thing they have to understand that and to give you a call, because you got to know what you're doing.
Every situation is different.
Yeah.
This article, the reasoning that this article is making this stance, I don't really agree with, but there are situations where the advice of that is correct. There's also situations where the advice is wrong. It really comes down to how long is that benefit going to be received, and what are you doing? What other rate of return are you earning on that money? If you're somebody who doesn't invest, you're probably better off waiting on Social Security. But I would say you should invest that money.
Yeah.
And if you can invest that money, and if you can earn a rate of return, collect Social Security sooner to supplement that investment growth. And overall, that's an overall net benefit by going about it that way. In most cases, not
As
all
usual,
cases.
great information. Thank you, Harrison. All right, that again is Harrison Johnson. He is our CFP, our financial planner here at Wilsey Asset Management. He is a fee-based planner. He does not, sell you product or insurance or whatever. And again, you heard a great topic where it's not always the same. And if you have a hammer, that's all you give. You got to sometimes use a screwdriver, different things. So you want a consultation with Harrison? It is free. Give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Well, Chase, you ready to talk about Citibank?
Yeah, let's look at it.
Okay, Citibank, their symbol, very easy. C, they're in the bank diversified industry. Only 1.6% shares on the short side. That's not bad. 81% institutional owned. disappointed in this. I thought the PE was lower at 16.3 versus the industry at 11.1. Price of sales 2.5 versus 3.3. Price to book value 1 versus 1.1. And then price to cash flow, nothing there versus 7.8. But the PEG ratio does look good at 0.8 versus 4.4. Now, we do see over the last year, the earnings did climb very nicely, 19.7%. And I don't believe they've reported yet, have they?
They did.
They did. Okay, so these are good numbers. Okay, I want to make sure of that. Up 19.7% for Citigroup. The industry was down 2.2. Sales for Citigroup up 5.4. Industry was down 0.8. And the analysts give them a 5-year growth rate of 14.7, well above the industry at 8.7. Now, you do get I'll say a decent dividend, about 2.1%. That's below the industry at 3.3. The payout ratio, 31.5%. That is below the industry at 36.5. Now, looking at the balance sheet and the bank, they have different accounting. They don't have current ratios, but their debt to equity is 1.7 versus 1.9, so that's a positive. Net profit margin, 17.2, which is pretty good, but the industry of banks is 30.1, so not as good as the industry. And the return on equity, not very good for Citigroup, 6.3 versus 10.7. And we do see return on invested capital is good, 16.6 versus 15.4. Chase, what do you got?
There's a current price here for Citigroup. Well, it's $113.59. The 52-week range, $55.51 is the low, and the high, $124.17. And you did bring up earnings. They did actually fall, it looks like 4% initially after reporting. It's kind of surprising me, but $1.81 per share. That beat estimates of $1.67 per share. And that was on revenue of $21 billion versus estimates of $20.7 billion. So they came in above expectations, but I think it's just done so well. I mean, prior to that report, they had grown like 50% over the year's time frame. So, I mean, it has done very well. It might have just been some profit taking, but the stock has been on a tear. I'm going to say that. Now, looking forward, though, for Citigroup, we go out to December 2027. We made that adjustment. Estimated earnings per share, $12.02. It gives us a target sell price of $199.53. It still trades for under 10 times those future earnings. I mean, the valuations look good. The only concerning factor I have is it's done so well. Can it continue to do well? And also, sometimes banks, I don't want to say they don't trade on the same multiple of earnings, but many times the price to book value is a more prevalent indicator for banks, and they have gotten more expensive on that valuation than they have been in the past.
I think Citibank was 1, so it wasn't that bad.
Mm-hmm. Yeah, they used to trade under book value pretty substantially.
And I do like 2026, the earnings were 10.21, or the estimate. You said 12.02 now, so that's a nice increase. And I was kind of concerned last year, like, oh gosh, the banks may not do well in 2026. So far, I'm kind of saying, well, maybe they are going to do okay. You want to be careful, but I think Citibank is a...
Well, a couple of thoughts I have with Citigroup in particular. Number one, they have my 2 favorite credit cards, actually. I mean, they have the Costco card and then the Double Cash card. I have 3 credit cards now. They own 2 of my 3 credit cards. So they got a good credit program, in my opinion. That could be problematic. Again, we talked about this 10% interest cap last week on the show. I think the odds of that going through is very, very low. But if it did, I mean, that might hurt Citigroup more than some of the other large financials. The other thing, it says they do have advisory services. And one thing we keep talking about is the M&A boom, the IPO boom that should be coming. And that should benefit, really, I'm going to say the Goldman Sachs of the world. I feel like I never really hear Citigroup as part of that conversation. Oh, yeah, they're in the conversation to bring SpaceX public. I never hear that. It's JP Morgan, Goldman Sachs. Those are really the top dogs out there. I don't know how big their advisory business is, but I think that is an area, the investment banking area is one that should be primed for growth in 2026. I'm not sure how much they're going to benefit from that.
And I believe Citibank has been more the one that loans worldwide.
Mm-hmm.
They don't seem
a lot of issues before.
Oh, a lot of issues before, but they don't seem to be as much in the investment side as the other ones. And you're right. I never hear Citibank. Oh, they have this IPO for it's usually Goldman Sachs, a big one. Then JP Morgan does a lot. And
then Wells Fargo, they have Wells Fargo Advisors. I don't know if Citigroup has that branch as well. So frankly, I don't know as much about Citi as the other money center banks like B of A, JP Morgan, and Wells Fargo. I feel like they're all pretty similar in business lines. I don't know Citi as well.
Yeah, I think it's worth looking into.
Yeah.
But I'm a little bit concerned on the lack of the diversification on the bank. So I would like to see a little bit more in there. So, all right, should we move on to the next company? What are we going to look at here?
I think it's Kraft Heinz is the next one.
Kraft Heinz Foods Company. I mean, gosh, what's going on with them? There's some interesting stories on them, isn't there?
Well, obviously we know that unfortunately Warren Buffett is no longer CEO of Berkshire Hathaway, and there was actually a filing that came out from Berkshire that they registered its entire 27.5% ownership stake for potential sale. Doesn't mean they're selling the entire stake, and my guess is they would do it over time potentially. I mean, if they flood the market with 27.5, oh man, that thing is probably going to come crashing down even more. But what this means is Greg Abel and co at Berkshire may be starting to unwind that Kraft Heinz position.
I know Warren Buffett was not in favor of that. We talked about how things will change, I don't think, for the better. Because Warren Buffett, he was upset that they were trying to spin something off and do this. Like, no, just keep doing what you're doing. But let's look at the numbers here for you.
Yeah, well, Buffett said it was kind of a mistake. He was wrong on the merger, but he said unwinding Kraft Heinz is not going to fix anything in his opinion.
Yeah. Well, Kraft Heinz symbol is KHC. They're in the packaged food industry, 7.2% short on the float. Only 61% is institutional owned. No PE ratio. Means over the last 12 months, no earnings versus 19 for the industry. Price of sales, 1.1. That's the same as the industry. Price to book value, 0.7 versus 2.2, but no price to tangible book value, which means a lot of intangible assets on the balance sheet. Price of cash flow does look good, 6.2 versus 10.3. Well, the PEG ratio, I've never seen one this high before, 125.2. That means you're paying a lot for the future growth of this company.
I'm assuming their growth rate's really low.
Yeah. Well, let's see. On the earnings growth, nothing there because they have no earnings, and that's 1 year or 5 year. Sales growth a negative 2.6%. That's not good. The industry's at 4.3, and then the 5-year earnings per share growth from the estimates or the analysts, is a 0.1% versus 3.6.
That's why the PEG is so high.
yeah, just not a lot there. Now they do pay a 6.9% dividend. No earnings, so they're borrowing, I guess, to actually pay that out. The free cash flow payout's about 53%.
I do believe then that's write-offs, right? Like if you have free cash flow, the earnings are distorted from something. It's not like, oh, this company's losing money. My guess is they had a big write-off, and I think they had to write off like Oscar Mayer. There was some major write-off they had last year.
That's why the free cash flow is so important. That's one big thing that we do look at.
They should converge over time, right? Like if free cash flow is high and earnings are low, free cash flow and earnings, that payout ratio should trend together over the long term.
They should, because eventually those write-offs you had aren't there. So eventually they should come pretty close to being the same. Never completely, but close. Look at the balance sheet. Current ratio 1.1 versus 1.4. Debt to equity looks very good, 0.5 versus 1.6. I do see, here's a problem, 73% of intangible assets on that balance sheet. That is dangerous.
A lot of write-offs.
Yep, a lot of write-offs there. Net profit margin, a negative 17.3. The industry's a positive 4.6. Return on equity, a negative 10.5 versus a positive 25%. Free cash flow, now this does look good though. Free cash flow for Kraft Heinz is $3.6 billion. The industry's at $3.8 billion. So that could be something that makes this company worthwhile. If you look over the history of companies with good free cash flow, they generally do pretty well.
Can you remind me again, what was the debt to equity?
Debt to equity was pretty high. Let me see the debt to equity. Where did that go? That's I'm on the wrong page.
While you're pulling that up, I'll look at the current price here for Kraft Heinz. It's $23.20. The 52-week range, I just really struggled. The low here, $21.99. The high, $33.35. Over last year, the stock's down 20%. Over the last 5 years, that stock is down 31%. And over the last 10 years, it's down 70%.
Debt to equity, 0.5.
0.5. Okay.
That's pretty darn good.
Yeah, pretty darn good. The only concern I have is if they do the spinoff, I assume more write-offs are going to continue to come. Now, that gives you, I think, a cushion, right? They're not going to have write-offs, and debt to equity is not going to spike to 150%. So if debt to equity is, let's say, 1 right now, and I anticipated more write-offs coming, I don't think I would touch the stock because that debt to equity could skyrocket.
Right.
But still, they have manageable debt. I think even with write-offs, it'd still be manageable debt. So, that wouldn't necessarily concern me.
Well, and I think I would almost say I'd like this company if it wasn't for the fact that they want to sell 27.5%. That's not good because any chance they get to unload it, they're going to unload it. They mentioned that they're going to do it. that's not good having that many sales in a company.
Well, let me give you the current estimated earnings
yeah.
for this company. $2.49 is the estimate for December 2026. I mean, it gives a target sell price of $41.33, trades around 9 times earnings. And to echo your point, I don't think I would touch this business until that Berkshire stake was maybe under 10%. I mean, it's just such an overhang, and it's such a wild card because we don't know the investment philosophy of the new management.
No.
And what is going to happen with that? I mean, they could have loaded it very quickly and the stock could plummet to $15 a share. And that sounds extreme, but I mean, shoot, you got to find a ownership for now 27.5% of a big company. That's a big problem. But I would tell you, if that did happen, I'd be very interested in this company at that level.
You know, just thinking out loud here, because their debt to equity looks pretty good. Could the company say, you know what, we'll buy back that stock and, you know,
It's
and
financial,
hold it.
yeah. I mean, that might be, and you might miss the opportunity. But again, I don't think I'd touch it until there's more clarity on the situation.
Yeah, there's a lot of danger here, but I think some potential. I'm kind of disappointed that they're talking about selling it because I don't think it's as bad as they think it is, and I know he's done terrible since he invested this, but it doesn't mean now it's a terrible price. So. All right, let's see. We're going to move on here. What are we going to move on to now? Oh, we're going to do a meme stock. Is that what we're going to do?
GameStop, yep.
GameStop. And I know they're in the news as well. I mean, something big happened. What happened with them, you said?
Yeah, so looking at the news here, Ryan Cohn, who's the CEO and chairman, he actually bought 500,000 shares on Wednesday and then also made another 500,000 share purchase on Tuesday. So he bought about 1 million shares in GameStop just this past week alone. I'm not sure. Again, he's kind of crazy to me in terms of what he wants to do. He's talked about, again, buying Bitcoin and doing some crazy things with GameStop and making it more of like a holding company rather than an actual company. But, you know, I don't necessarily know if I'd follow him blindly into this. I'm going to put it that way.
Well, the numbers don't look great at the start here. And again, GameStop is a company that's symbol is GME, Specialty Retail. The short on the float is 16.1%. That's pretty high. Institutional ownership is only 39.6%, so a lot of people like him maybe out here holding the stock. A lot of, what was it?
Diamond Hands. It's your
Diamond Hands
your
and Kitty.
Roaring Kitties.
Roaring Kitties.
I mean, there's still probably people that bought it during the meme craze.
Yeah.
They're like, it's going to come back.
Well, the PE ratio is at 26.1 versus 23.3. Price of sales, 3.1 versus 0.7. Price to book value 1.9 versus 3.5, and price of cash flow is expensive 20.2 versus 9.1. Now, over the last year, their earnings are up 340% versus 8.5 for the industry. I'm sure that's because previous year the earnings were very low. Sales, however, and I don't know what they even sell anymore. I mean, I think it's more of a gambling.
I still do like trading cards. Like I took my old Xbox in, and unfortunately they wouldn't take it because my controller was dusty or something stupid. But I went in. That was the first time I'd been in the store, and let me just say it's a little rundown. But they still have collectibles, cards, games, secondhand exchanges of video games and stuff like that.
They're still doing retail business, but not very much because I say sales are down 12.1%. 5-year growth rate from the analysts is a negative 48.1%. So that's not good at all. They do not pay a dividend. Well, this is amazing. The current ratio, 10.4 versus 1.7. Quick ratio, 9.8. I'm going to look at the balance sheet, I think, when you're looking at your stuff, because they must have a lot of cash sitting there somewhere, or short-term investments. That's a lot to have. Net profit margin is good, 11.1 versus 3.2. Return on equity, 8 versus 19.5. And free cash flow, 569 versus 1.3 billion. So,
well, that's kind of what I was talking about. Is Ryan Cohn's done some crazy stuff where they actually sold stock to, maybe buy Bitcoin or use it for investing purposes. So kind of trying to almost follow like a micro strategy type plan. And basically, I think he's doing anything to try and lift GameStop stock's price. But of course, it's a lot of high risk stuff. But let's look at the current price for GameStop again. Their ticker symbol GME. Current price $22.99. 52-week range. The low is $19.93 and the high $35.81. Over the last year, it really hasn't moved. It's gone down actually about 19%. Over the last 5 years, you are up 20%. But it's important to remember the GameStop craziness happened in January 2021. It spiked to $86.88. So if we look at this next month, the 5-year return is probably going to be a big decline.
Yeah.
So this is, again, we're comparing that 5-year period where the craziness really started. But looking forward, there is an estimate for positive earnings. I go out to January 2027. Estimated earnings per share is 81 cents, gives us a target sell price of $13.45. I will say that's better than I anticipated, but important, just one analyst. I bet you a lot of these analysts are like, this isn't even a real company anymore. I don't even think I want to follow it.
Right. Look, I did look on the balance sheet and the cash, and back in 2023, they had $1.2 billion. They're now at $8.8 billion.
So I mean, he sold a bunch of stock to bring in cash, and people got all excited about it because they're big believers in the meme stock craziness.
Meme stocks and Bitcoin and everything else that's crazy. There's a closing bell. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great educational information there. Thanks for listening. We'll be back next week right here on the Smart Investing Show with Brent and Chase.